Fiserv stock FI is collapsing, losing around 40% of its value today, tens of billions of dollars. And looking back over the past year to date, it is down 60 to 70%. So this has been a huge collapse in the stock. I previously called out to my subscribers at Unrivaled Investing that I actually completely sold out of my Fiserv position literally at the start of this year at over $200 per share. This was over 100% gain from when I owned it. And I'm going to spend a little bit of time walking you through my thought process for why I previously sold at over $200 per share, why I previously bought closer to $100 per share. So it's now back below where I was originally buying just a few years ago. And so let's go through what's going on with Fiserv, because there's a lot of developments here. You know, I'm personally a little grateful that I avoided the heartache, the burn that a lot of people probably are feeling today with a 40% drop. I mean, that's tens of billions of dollars in value that, you know, is effectively evaporating. So this video is going to walk you through very high level Fiserv, what they do, why it's declining, and where do I think it could go ahead in the years ahead, whether or not it will fit my personal investment journey with these latest developments. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing. And so looking at Fiserv, part of the reason why you're having this drop is there's a lot of new management, changing of the guard. You have new co-presidents, a lot of hired guns with prior experience at JP Morgan, Stripe, Optum. You have a new CFO. You have new independent members of the board of the directory with new audit and new independent chair. So I look at this, and this is a dramatic sort of change up. And I think it reflects the fact. This is one of the key reasons why I sold the stock. And, you know, Unrivaled Investing subscribers can see it, can track that history, which is that Frank Bisignano was previously the CEO orchestrator of how Fiserv performed, the acquisitions they made, you know, the big bets they considered, the integrations. And he was a big part of the reason why they were able to deliver double-digit earnings per share growth each year. Now, there's a little bit of an allusion to it over my shoulder. I'm going to get to it in a minute towards the end of this video. But whenever I see something that's consistently positive going forward, I go, okay, that's pretty interesting, but I want to be cautious. I want to be mindful, because there's been many examples like this throughout not only financial history, but also you might even think Thanksgiving. And so we'll talk about that towards the end of this video. But when I saw that Frank Bisignano, the former CEO who orchestrated so much about Fiserv, was getting called away effectively to help run the Social Security Administration for the President Trump administration, I thought to myself, okay, the management alignment is no longer there, because here it is, he owns this big stake and he's leaving. And I want to make sure, for my own personal investment journey at Unrivaled Investing, one of my key checklist items, arguably number one, is management alignment. And if I lose that, it's really hard for me to have the conviction to say I want to buy if there's trouble ahead. At the time, there wasn't trouble. At the time, the stock was up over $200. You know, up over $200 per share, up over 100% for my cost basis. So now looking at it, why is it declining? Not only do you have this change in management, which suggests there might be some problems underneath the hood, you have this dramatically revised lower guidance. And you can see the revenue outlook around 3-4%, low single digits. You see adjusted EPS now around $8.50. You see margins expected to come in around 2%, so a significant margin hit, and free cash flow of only around $4.3 billion. That's still a lot of free cash flow. So part of this video is going to say, wait a second, even, you know, based on this new lowered reset, what do I think about the business? So I think it is important to recognize there's still a company generating billions of dollars of free cash flow. Yes, it's lost billions of dollars of market cap, way more in market cap than it's lost in free cash flow. You know, it's still generating lots of free cash flow. So it is important to recognize there's going to be a difference, but just from where they were guiding during the first quarter of this year before the new management, they were talking about, hey, we're going to be growing double digits. We're going to be posting $10 per share plus an adjusted EPS. You're talking about a huge haircut here. $8.50 from $10 plus. They're talking about margin expansion from 1% plus margin expansion to a 2% contraction. $5.5 billion in free cash flow versus their new guidance, which is closer to $4 billion. So that alone, in my opinion, is enough to shock Wall Street. It's surprising to me as well. Where did that $1 billion in free cash flow go to? Is that just aggressive assumptions that were previously made? Is that, sort of sketchy accounting that was considered? Because generally a company's free cash flow, that's much harder to manipulate. I mean, you still can do it, but going from 5.5 to 4 billion, that is a significant haircut. So here it is on today's call. The new CEO, he makes a clear point of saying, look, during the third quarter, my first full quarter as CEO. So, hey, I've only been at it for a little while. Don't judge me for this reset. And he's effectively saying, I have to do this big reset because there's a lot of things going on. One of which is there's some changes in Argentina. I don't put a lot of weight on that comment because what's going on in Argentina is you're seeing much more controlled inflation. Yes, you are seeing an impact to the economy as well, but overall, this isn't, I think, the biggest driver. I think it's really the recalibration, as he's saying, of optimistic growth assumptions and the impacts of certain deferred investments and deprioritization of short-term revenue and expense initiatives. This is all code for the previous management was doing things that sort of mucked up the business, and I want to run in a different way. And that's the reason why you're seeing this, like, out with the CFO, the old CFO who previously worked with Frank Bisignano, the old CEO, you're going to bring in these new presidents that are going to help run operations. And it's effectively saying, yeah, this is a mess. And this is going to take a little time to turn things around. That is the very reading between the lines signal that management is saying. And like, we previously weren't making the investments we should have been doing. We were focusing on short-term stuff that we shouldn't have been doing. Now we got to reset and we got to live with the consequences. And the consequences are flat revenue, declining profit margins, declining earnings. That's what you're seeing in this quarter, and that's why the stock's resetting so significantly. When you dive into the individual segments, merchant solutions, this is actually what turned me on the most about the business originally. It's effectively a toll booth on millions of merchants. And when you look across their various different business lines, small business, enterprise, and payment processing effectively is a commodity now, and it's been declining for some time, coming under increasing amounts of pressure. Small business and enterprise, you have different things under, different currents. You have their Clover brand, which arguably is taking share, but then you have their legacy operations, which arguably is either declining or just not growing at all. So the net effect is only growing around 6% organically. And so I look at this and, I don't think the payment industry, the merchant solutions industry for small and enterprise businesses is growing significantly faster than that. But I look at this 6 to 9% and I'm thinking you're probably growing in line net with the market. So you're not dramatically losing market share on whole, and you're also not dramatically winning market share. And I personally prefer to align myself, even though I love toll booth businesses. Every time there's a dollar going across your platform, you're getting some percentage of that, and then you benefit from more business and you benefit from inflation. Those are the types of businesses I love. But in this case, I'm looking at it and I'm saying there's enough challenges going on here that you're just really growing with the market. And I would rather own the payment solutions that are rapidly taking market share. That's a key part about my investment checklist, is this obvious growth. And I'm just not seeing it here when you look at their net results. When you look at financial solutions, this is more about the plumbing for literally talking about hundreds of different banks providing the key tools that they use to power their customers. And so they have digital payments. Think about, making it possible to do Zelle transactions for banks. You have issuing services and banking services. Overall, this has been a business that arguably is not going to be a hyper grower. It's been actually contracting now for a while. And, it's contracting a couple percent. I view this as there's either it's not dealing with growth industries, or it just doesn't have a product set that's going to rapidly take a lot of market share. They don't have some sort of new solution that they can then drive a lot of sales. So this is another example where I'm saying, okay, I'm not seeing obvious growth. I am seeing a lot of critical functionality for a lot of players, but I'm not seeing the growth that makes it obvious to me. Still, this is a company generating billions of dollars in free cash flow, $4 to $5 billion in free cash flow, and it's $75 per share, a huge haircut. Even to when I was originally buying closer to $100 per share a few years ago, it's, $40 plus billion market cap versus $4 to $5 billion in cash. I mean, just think about this. Before you have to do any sort of deep dive, that alone should tell you it smells kind of interesting. Because if you have $40 billion market cap and you're generating $4 to $5 billion in free cash flow, if that cash flow can indeed go to you, and you can see management has historically actually returned more than that amount in share repurchases, then you're saying, hey, at the current share price, you could retire possibly 10% plus of the stock per year. So if the business just stays flat, you're getting a 10% type of return, giving no credit to valuation expansion. So that's a setup that a lot of value investors are going to be thinking about following this decline. I strongly suspect that. Wouldn't surprise me at all if you see value investors, sort of give a bid for Fiserv following this result. Now, as always, none of this is financial advice, because the next question is it now going to be part of my investment journey again, given that it's fallen off? First of all, quick plug. Earlier this month, Joe R. shared, Daniel, thank you for all your insights. I have made almost $1 million following along with your investing journey. This follows Andre S., who wrote, since I've joined, my portfolio keeps on growing without me having to worry about it. Thank you for your service and making my life easier. This is the last week of the current prices, so now is the time to lock it in. Come check out Unrivaled Investing. So the clue that I was referring to earlier, and you might see it over my shoulder, is, let me make myself full screen, is I have Nassim Taleb's Black Swan and Anti-Fragile books. And the reason why I think it's important to reflect on is, especially for this time of year, I love Thanksgiving, is that it's sort of like the life of the turkey. If you were to judge a turkey's, health and life, their well-being, you'd say, wow, this is, a lot of people would say, this is focus on this chart. Rah, rah. This would become an incredible stock market chart. Like every day it's going higher. And then, a month before Thanksgiving or a few weeks before Thanksgiving, it gets slaughtered. That's a surprise. And that was the concept from Nassim Taleb's book, which is that, sometimes when something's consistently positive without seeing any sort of volatility, it might be actually a warning for you to be looking out. And I actually felt that way when I saw Fiserv consistent 10% plus adjusted earnings. I thought overall that's quite impressive, but I want to make sure the person who's running this, orchestrating this, still has a huge amount of skin in the game, which at the time he did, and that he keeps running it. But once you lose one of those key dynamics, do you run the risk of being the turkey before Thanksgiving? And I think that's largely what's been happening with Fiserv stock. Now, what happens from here? This is a key insight from Flash, completely free to use on reports for any company, deep research reports on any company around the world. And this insight is the hypothetical 5-year scenario analysis. I'm aligned to agree with this, which is that, if they execute and you have a successful reset, there is a chance that this is 100, 200% higher over the next 5 years. I mean, once again, just going back to what we were just talking about, you have $4 to $5 billion in free cash flow just if the business is flat. And that's 10% per year. So if you're able to get a little bit of growth, then you're talking about closer to that base case. You're getting that 10% plus a little bit, plus maybe a little bit of valuation expansion. But if you're able to get all the pieces, growth, cash flow, valuation expansion, then you are talking about that high case. If you have things keep falling off, falling apart, then the low case probably makes sense. But I personally, I'm arguably more optimistic. And I would probably think that the high base case is more likely personally than the low case. Look, AI can be wrong, and that's why you have to use your own judgment. I view it as a junior analyst at this point, but I think the starting, assumptions is ballpark right. But then going to the question of, will it go, become part of my investment journey again? And that's where it's hard for me to say I want to make this part of my investing journey again, even though it's arguably quite cheap, 10 times free cash flow. And the reason being is management alignment. That is just such an important aspect to this. It's easy for the current CEO. I should say it's easier for the current CEO to come in and say, look, everything they were previously doing, there was a lot of missteps, poor investments. We got to do this big reinvestment. He's still going to be making millions of dollars. The new co-presidents he's hiring, they're going to be making millions of dollars. They're all happy, net. They're all going to be better off. But you as a shareholder may not. And that's where I want to see this huge buy-in. I want to see this new CEO and president say, hey, instead of getting $1 million salary, we're going to take $100,000 salary or $50,000 salary, and it's 100% is going to be, or the rest is going to be in stock-based compensation, or we have to take a bonus and buy, stock with the cash proceeds of the bonus. That's the type of alignment that I want to see. But at this point, I'm not seeing enough to say, yeah, this is obviously a situation where management's going to get this right and get the stock price much, much higher. I haven't seen enough to get me there. Of course, things can change, but it also reminds me, honestly, a little bit of what happened previously with General Electric. Jack Welch, consistent beat by a penny, earnings. Jack Welch, he leaves, he retires, and the story falls apart. And I'm thinking to myself, ultimately, General Electric turned around when they brought in someone that had done it before, had proven that they could turn it around. And so I'm thinking maybe that's what we need to see here. And we see that type of management alignment. You see these big investors say, hey, we want to put this guy in who's a specialist at turning this around. So I think we're going to be in this period of new big investors coming in, value investors. I'm very curious if we get some activists sort of come in. When I think about obvious growth, that's also a key failure here with Fiserv. And you can see it in the results. It's not obvious to me at all that this business, this enterprise is going to be much larger in the future. I do think that there's a good chance their share count could be much lower because of their buybacks, and thus the share price could be higher. But I want obvious fundamental growth because that really juices your investment return. So I'd say those first two items, management alignment and obvious growth, it's just not there at this point. Compelling valuation is. And so I would rather find something, even though this trades at 10 times free cash flow, there's a reason. And so I personally, for my investment journey, I'd rather find those companies because when you have that management alignment and there is a recession or there is a, catastrophe and there's a, maybe there's a market shock and interest rates spike higher. I know that when you have true management alignment, the CEO or the founder, they're going to be waking up in the middle of the night thinking about those problems so you don't have to. So that way you can say, hey, this stock is going down. Maybe I want to buy more because I know the alignment's there. So I don't see that yet. Would not surprise me at all if Fiserv does well from here, just given how cheap it's become. But it's not going to be part of my investment journey at this point. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.